for a lot of people don't know how the 10-year treasury works, or the 7 or the 5-year. The 10-year treasury is as people buy it, the price of it goes down. As people sell those bonds, the price goes up. And so that's a really good indicator in my mind of how investors and people are thinking. What's the general thought process around the economy, et cetera. It's also, the benchmark for our borrowing with agency debt. But it's something I pay attention pretty regularly too.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is Julian Vogel. He's a fund manager at Colonial Hills Capital, real estate investment firm formed in 2008 and focused on secondary markets. His 8+ years experience in commercial real estate acquisitions, repositioning, and capital markets. Worked on financial structuring and sourcing of over $1 billion worth of commercial real estate, former VP at a top 15 commercial mortgage brokerage firm. Julian has a wealth of knowledge, and we dive into one piece of that today, and you're going to hear us talk about it, of course, but the capital stack. And it's a part of syndicating a deal that many people have questions about, right? Especially as LPs. What does that mean for me? Where am I at in that capital stack? And what are the ramifications of that as a passive investor? And so you're going to learn a lot about that today. Such a big part of the syndication business is structuring our capital, and sometimes called the capital stack, or where's this capital coming from? And our guest today is an expert in doing just that. He's worked on financial structuring, sourcing over $1 billion worth of commercial real estate. And so I'm excited about this conversation because this is a topic that I feel like we spend a lot of time on this when we're doing a project, right? And thinking through what that structure should look like. And so I'm looking forward to learning from our guest today, Julian. Julian, welcome to the show.
Thanks for having me, Whitney. Pleasure to be here.
Honored to have you. And so tell us a little bit about yourself. Obviously, Colonial Hills Capital, who are you? What's your all's focus? And let's jump in.
Sure. So I'll start with Colony and then I'll get to myself. So Colony is a private real estate company. We're based in Western Massachusetts, and we focus solely on the acquisition and repositioning of garden-style multifamily real estate. Probably a story you've come across many a time before. We've been doing it since 2008, and to date, we've done over 1.2 billion in total capitalization, a little over 12,000 units. We just completed our 36th transaction, and on deals that we've taken full cycle, meaning from purchase to sale, we've had an average gross levered IRR of 36%. We've had a lot of growth in the last 4 years as a company. And it's exciting time for the company, even with the markets up and down. Colony's doing well. And then as far as my role, my title is the fund manager for the company, but I actually wear two different hats, similar activities. The first hat as the fund manager is I determine all of the fund strategies. We're about to launch our third fund. And also I oversee the capital raise for those funds. And then on the other hat I wear is I structure and source the debt and equity on a transaction by transaction basis. Prior to joining Colonial Hills Capital 4.5 years ago and change, I spent my whole career working as a commercial mortgage and equity broker. I had my own business. I worked for a top 15 firm based out of Englewood Cliffs, New Jersey. I worked for a family office. But basically all those roles I was doing, a similar thing. I was structuring debt or equity for multifamily, self-storage, office, construction, acquisition, refinance, single family rental portfolios, self-storage, et cetera. So a lot of fun, a lot of exposure. And I'm excited about what I do and where we're going at Colony.
It's incredible. Julian and I were talking about before we started recording is how he loves what he does, and it's such a blessing to be able to do that every day. There's never a bad Monday morning, right?
Yeah.
But I want to jump into that. And how many deals full cycle did you say again? Average IRR, levered IRR of 36% over and how many?
16 deals.
Congratulations.
Thank you.
That's a great track record, right?
Thank you.
I love that. So you determine fund strategies and oversee the capital raise, debt. I'm sourcing the debt and equity. That's a lot of the deal. I mean, you're doing a lot to make the deal happen, right? Get it to the closing table. But let's dive in on your superpower, and I'm sure we're going to talk about a number of other things most likely, but structuring this capital. Why don't you give us a high level, like what does that mean exactly? Maybe for some listeners who may not have syndicated a deal yet. Most of them probably have or have invested passively in enough deals. They know what you're talking about, but just in case, give us high level. What are you talking about? What does that encompass exactly? And let's jump in.
Sure. So before we talk about structuring capital, I have to talk about the actual deal. So because typically the capital is really just to facilitate the deal and what the deal needs. So you can have a deal that is mismanaged and 60 or 70% occupied, but in a great market. You're not going to put long-term financing on it, right? So as far as structuring the capital, I'm starting with the debt, right? Because the debt is the largest percentage of the stack, right? Even low leverage is 50%. High leverage is 75, 80, right? So that's a huge part of the stack, right? You got to talk about that. And depending on the debt really can make or break the deal. So if I have, like I was just saying, if I have a deal that's sort of disheveled and needs to be set back on course and needs renovation dollars spent and is going to be a quick hold, I'm not going to put perm financing or long-term debt on it. I'm going to put bridge financing, 1 to 3 year term, maybe with 2 1-year extension options. And those pieces of debt are usually variable rate, sometimes fixed, meaning there's a floating rate interest rate. And typically the leverage is higher. It's 70 to 75% of the cost. So, or if I have a deal that's already stabilized, it's 90% plus occupied and is a high cap rate deal, meaning it has strong cash flow going in, I'm probably going to put 5 to 10 year fixed rate debt on it with modest leverage, something like 65, maybe 60 to 70% loan to value or loan to purchase. Okay, so now I have the debt set. I'm now going to figure out what sort of equity do I need to fill in the rest of the stack. Do I need pref equity? Do I need LP equity, typical LP equity, traditional LP equity? So pref equity is, a lot of times people look at it as just additional leverage because it's equity.
So I guess I want you to even break that down a little more, even layman's terms. Like you say, pref equity. A lot of people are not going to, or a few may not have a clue what you're talking about. And so, what does that mean, just in layman terms? And then we'll move on.
Sure. So preferred equity is a piece of equity. It's not debt, and it's typically 50% of the equity requirement. And it's a position that has limited or capped upside. So it gets first dibs on the available cash flow to a certain priority return or current pay. So let's say 6 to 7%. So 6 to 7%, the first cash flow off the property after the debt is paid goes towards paying this preferred equity partner. And then after that, 7 to 8% preferred return is met, the rest of the cash flows goes to the GP equity or the rest of the equity. And then on sale, this pref equity piece has a limited upside. So it got its current pay throughout the ownership period. And then on sale, it gets its capital back, plus a little bit of an accrual. Let's say if it was getting 8% during the ownership period, maybe it's got a 4% accruing throughout the ownership period that it gets in the back end, maybe 5%, but it's capped. And in that way, it's similar to debt. And it's also similar to debt in that it gets priority of the cash flow. The alternative to that is LP equity, which is, hey, I'm the GP, you're the LP, I'm the general partner, I'm running the deal, you're the LP, you're the passive partner who's bringing in the lion's share of the equity. You're going to bring 80% of the equity, I'm going to bring 20%. We're going to split the cash flow available from the property based on our percentage ownerships in the deal. So I'm going to get 20% of the available cash flow, you're going to get 80%. And then on sale, right, that's where the interesting stuff happens between the GPLP through what's called a waterfall structure. So it really depends, to answer your question, how we're structuring. It really depends on the strategy of that deal, what that deal needs, and what I'm looking for out of that deal. Is it a high risk, value add, heavy lift deal? Okay, like I said, I'm putting short-term debt on it. Maybe I'm even putting pref equity on it. Is it a coupon clipper? Is it just a stabilized deal that's throwing off cash? I'm going to put on perm financing. I'm probably going to use LP equity, the traditional LP equity that I just described to you. So first have to understand the deal, what the strategy is, and then you source and structure the capital around that.
Yeah, I love this. Just talking through this, I think often, especially newer passive investors, they're confused when you start talking about the capital stack and what that entails, and ultimately where they want to know where they're at in that, right? Like, what does this mean for me, the passive investor or limited partner? And I've seen, we all put these diagrams, I think, in our marketing now, as part like kind of showing that capital stack, right, and showing where the debt lives and where the LPs are, right, and then where the GPs live, in this stack. And I love, how you talk through just the typical, say, percentages of how much is there, in a deal, of each of those. And no doubt the debt can make or break a deal. I think, so many, all of us are feeling that at the moment, right? As we're looking at some of your projects now that we can't make work because of the debt often. But what are maybe some creative structures that you've seen, Julian, or that you all have come up with to make deals work, or how have you, maybe moved that capital stack in ways that, are different than the norm, right? Often we see that, say, 50-60% debt, or more, right? And then obviously the LP, the pref equity, and the the GP on top of that, in those kind of percentages roughly. But any different ways that you all have come up with that say, what, we did this thing this time and we're able to get a deal done because we changed it around like this?
Yeah, it's a good question. So I'll answer based off what we've been doing recently. So like you mentioned, Whitney, with the debt being a struggle these days, really the cheapest financing available is probably agency debt, right, from Freddie Mac or Fannie Mae, government agency financing. And that financing ranges from, 55 to 65% on purchase. And typically the interest rates for that debt is these days 5.5 to 6%, right? Depends on where the property is and what the cash flow is. And it's long-term financing. It's 5 to 10 years term fixed. So we've been using that. And then to supplement the missing leverage from that debt, we have been using pref equity. And there's basically two different types of pref equity. There's the pref equity that I just described before, the preferred equity that I just described. And then there's what's called also a participating pref equity, where you have the same structure I just described, but on the backs on the sale, they have a little more participation. And for that extra participation, they'll write a larger check out of the gate. So instead of maybe providing 45 or 40 or 50% of the equity, they'll provide 60 or 65%. And now the deal for the GP is starting to look very attractive, right? Because it has attractive leverage. It has solid, low leverage fixed rate debt. And then it has some soft participating pref equity on top of that, which only leaves us having to bring, 30-35% of the equity in a deal. And it really helps and increases and improves our forecasted returns to the GP. So that's what we've been doing. We've done that on 2 deals recently. The tough part on that structure, right, there's a lot of pros, but there's also the con. The con of that structure is that when we approach GP equity or co-GP equity partners to come in alongside Colony Hills on top of that pref equity that I just described, right, that last 35 to 30% of the equity, they look at the deal and they say, hey, great market, great sponsorship, returns look very nice, but I don't want to be behind preferred equity. I want to be pro rata. I want to be like more of a typical GP LP equity position, which, by the way, Whitney, I'd like to describe at some point. I think it'll be helpful to the listeners. But basically, that's the resistance. They say, "Hey, I don't want to be behind this structure." So at Colony, what do we have to do? Well, we basically make our carried interest or our take of the upside very modest, because we're asking investors to come alongside us behind a preferred position. And so when they look at that modest take that the Colony has, and they're really in a position where they're pro rata alongside us, where they're even Steven with us, right, in the GP, they soften up to that structure, and then they really get on board with the deal and the forecasted returns, right? Because the term risk adjusted returns means I have to get a higher return if there's more risk, and I'm satisfied with a lower return if there's less risk. If I'm asking a co-GP to come into a deal with me on top of pref, they're going to perceive that as high risk. They want and need high reward. So we structure that, and that's the way that we've been structuring it, and it's worked.
Okay. So that's interesting. And so ultimately they're just aligning more with the GP.
Yeah.
Yeah.
And their forecasted returns are, 20 to 25% net IRR, with some cash flow, also with some yield. So we'll have usually an average yield of somewhere between 6 to 8%. So it's good deal, good structuring.
Yeah. Is that say lessening say maybe the pref that they would typically get early in the deal?
Is it lessening the pref that?
Well, just like lessening the cash flow to them early in the deal for a bigger back end.
It is.
Yeah.
It is. That's a great question. Yes, it is. We've occasionally funded some distribution reserves to supplement that, what they're missing in the front end. Some investors say, hey, I'm what they like to call drinking my own blood, right? I'm putting my money in and then just getting it back. So it depends on our investor base. Some don't care and they still want to see that yield in the first couple of years. As the property catches up and goes through its value add strategy and throws off more organic cash flow.
Yeah. What are you all? What's it look like on the debt front for you all? Say right now, you mentioned, as we briefly mentioned, that it's harder right now to find, or to make deals work because of the debt right now. Are you all making deals work right now? And what kind of debt, outside of maybe what we've already talked about?
So really only agency. We've continued to explore some, bridge financing options, but recently they have not been compelling enough for us. And we also, in 2021, we had 5 deals we did, and we put bridge financing on, right? Floating rate variable debt on. And they were great looking deals at the time, right? But thankfully we bought rate caps, right? And we manufactured a ceiling for that floating rate debt. But, as everyone experienced, April 2022, that was the first rate hike that I can remember. And then swiftly we hit that ceiling of our rate cap on those deals. And the interest rate, along with insurance and taxes, sort of just strangled the cash flow. So we learned our lesson, and now we're just doing agency, debt, fixed rate, low leverage. And then also the other thing we're looking for on the acquisition side is a term called neutral leverage. So what that means is that our going in cap rate needs to be based on our purchase price or our offer on the deal. Our cap rate needs to be at the amount we're borrowing or higher, right? So if we're borrowing, if we can borrow at 5.5%, we want to see that our going in cap rate is also 5.5%. We'd prefer it to be even higher, right? If we can borrow at 5.5%, we want our cap rate to be 5.75% to 6%, right? Because a lot of listeners maybe don't know what cap rate is. It's a simple equation. It's just the NOI divided by the purchase price. It shows you what your yield is for this property. And so if you compare that to your cost of capital, your interest rate, gives you a good sense of like how healthy is this property going to be based on my financing, based on my interest rate.
Yeah, no, I appreciate you mentioning that. No doubt, I think many, including us, have learned a lot from the deals purchased in 2021, right?
Yeah.
During that time frame. Anything you all are doing specific there to help those deals to perform, even though they may have, you said it maybe had a limited cash flow or expected cash flow.
So we've had to feed some of those deals cash, right, to cover their shortfalls because they're value add deals. Thankfully, we bought those deals though in strong markets where the average median incomes are high and industry is strong, and so and people want to live there. So one of the markets where we own a few deals where we're experiencing that is in Houston. So the expense side of the equation is, like I said, the uncontrollable expenses, tax, debt, and interest and and insurance clobbering the cash flow. But on the income side of things, thankfully, there's demand, and so we're outperforming our target premiums for rental income because we bought in those strong markets. So now we're just kind of seeing through the storm. We're just keeping our plan going. We're increasing occupancy. We're increasing rent, and then hopefully the idea is that the income becomes positive, right? Takes care of those shortfalls, and then sometime between now and the next 5 years, hopefully interest rates come down as inflation is put at bay, and then hopefully cap rates follow and values increase, and then we'll be in a position to sell those assets.
Yeah. Thankfully, you purchased a cap, right? We have a couple
That's right.
projects that are in a similar place as well. So I don't think you're alone there.
No.
Julian, I ask everybody that are operators and experienced like yourself, just obviously predictions, over the next 6, 12, 18 months, just in the real estate market. I know nobody knows for sure. However, what we believe is going to happen does affect what we do, right? Whether we're buying or selling, or just any thoughts on what you all are predicting, for the next, 6, 12 months.
I'm of the opinion, nobody knows, but I'm of the opinion that people are very wealthy still right now, and they have a lot of liquidity and spending power. I think one of the silver linings of COVID was remote working. That basically enabled the job pool to expand to the whole country as opposed to just wherever your office is, which is huge in my opinion, and you can't compare it to anything in history really. And so I think from that perspective, and also the jobs report comes out, it's strong. The past few reports have been strong each time, and so I think that will cause inflation to take longer to come down than I think everyone hopes. And I hear rumors that they're not going to raise rates again, and it's going to stay stable for the next few quarters until they see what happens with inflation. So I'm of the opinion that this is going to take longer than I think everyone hopes. I think it'll take another year and a half before rates start to creep down. And so we're just going to continue with the same strategy that I just described until that happens.
Yeah, no, I appreciate that. I think you're better to plan that it's going to take longer. Right.
Mm-hmm.
Than shorter. Julian, what's your best source for meeting new investors right now?
That's a good question. So we use multiple channels. So first of all, conferences. I try to go to a few conferences a year. We also have SEO for our website, and we have different, we use leverage social media, etc. So we have a lot of investors who just find us, who come to our website and reach out, and my assistant will set up a call with me, and hopefully most of the time they want to move forward. We also use intermediaries, broker dealers, independent broker dealers. That's our main source, I would say, of investor dollars. At this point, we probably have 5 to 6 different relationships that we hold near and dear. And then the last outlet has been crowdfunding. We've worked with 3 different crowdfunding platforms in the past, both for our fund and for direct deal investments.
Nice. So do you all have an Evergreen Fund? Is it a multi-asset fund? Is that how you're partnering with broker dealers, or is it a deal by deal basis?
No, so it's not Evergreen. It's closed-ended. It is a pool though of assets. So for example, the first fund we raised is a co-GP fund. That's what our funds are. They're co-GP funds. So the investors, we aggregate the investor dollars. They're all LPs in the fund, right? And then we take that liquidity and we invest it alongside us into the co-GP. But it's an 18-month offering period for each fund, meaning we can take in capital for 18 months, 2-year investment period, and then the fund term is 5 years. And so for Fund 1, we raised $20 million. It was invested into 7 assets, $380 million worth of real estate. Fund 2 is still active. We raised $25 million. It's invested in 3 assets, about 350 million worth of real estate. We'll probably buy 1 or 2 more deals in that fund. And then we're going to launch our third imminently, probably in the next month or so. That'll be 25 to 50 million. So it's close-ended, intentionally small, right? Because it's co-GP capital. It's really only supposed to represent 5 to 8% of the GP of the total equity in a deal. And so that's worked for us. The co-GP concept, along with pref, I'd say are the 2 hot terms, right, amongst investors. That's what where they want to be. And I don't blame them, right? It's two polar opposites. One's income, the other one's capital growth, right? I want one or the other for my portfolio. So.
What about, Julian, your best advice for passive investors right now?
I would tell a passive investor, first of all, to due diligence intensely the sponsor that you're going to invest with. Get references. How many deals have they done? How long have they been around for? How many deals have they taken full cycle, meaning from purchase to sale? Number one. Number two, if we're talking multifamily, what markets are they focused on? Are they focused on markets where there's demographic growth that have strong industry? Because those are your tenants. Those are the people paying the rents. And number three, I'd ask to see their underwriting. I'd really like to, if I'm an investor, I want to see what sort of constraints and assumptions are they using? What's the going in cap rate? And then what are they projecting to be the exit cap rate on sale? That's, in my opinion, the easiest place to look in a model to figure out what kind of sponsor you're dealing with. If it's a conservative exit cap rate, you're working with a conservative sponsor, and probably they're going to outperform their pro forma. If it's a low cap rate on exit, they're buying it at a 5.5 cap and they're assuming they're going to sell it at a 4.5 cap, I would stay away because they're setting you up to really to go off a cliff. Because if the cap rates don't come down, their model blows up. So that's kind of the easiest place to look. And then if you want to get deeper and you're sophisticated, you could look, in other parts of that same model. And then last piece is what sort of structure are you investing in with this sponsor? Are you investing, like I said, in a preferred position? Maybe income is your thing, and that's great. Or maybe you want capital growth, like I was describing before. And so look for a co-GP position. That's a more and more of a popular term. 3 to 4 years ago, it really wasn't. I didn't hear people talking about it much. Now, it's a pretty commonplace vehicle and concept, co-GP. So it's cat's out of the bag, so to speak.
What are the most important metrics that you track? It could be personally or professionally.
With regards to
Anything.
real estate,
It could be your bench press number. It could be how many deals you all analyze. Anything. What you consider your most important metrics?
It's a great question. For me personally, right, because my position is capital raising, it's capital raising. How much capital have we been able to raise? Deal flow is sort of not in my control, so it's difficult for me to. I pay attention to it, obviously, because that's how Colony makes money. That's how our investors make money. But I leave that to the deal team. And then the other thing I pay attention to is the 10-year treasury. I look at that pretty often because I think that's, unlike the overnight rate or rates, I should say, or other indices like SOFR or LIBOR or swap or et cetera. For a lot of people don't know how the 10-year treasury works, or the 7 or the 5-year. The 10-year treasury is as people buy it, the price of it goes down. As people sell those bonds, the price goes up. And so that's a really good indicator in my mind of how investors and people are thinking. What's the general thought process around the economy, et cetera. It's also, the benchmark for our borrowing for the agency debt. But it's something I pay attention pretty regularly too.
And how do you like to give back?
So I give 10% of my income to charity, to different charities. So that's how I personally give back. I also give back to my wife. I give back to my kids. I give back to my parents. I try to give back to my community.
Love that.
So.
Julian, Grateful to have met you and just to dive in a little bit into your superpower and just talking through, just the capital stack. And I think it's helpful, for any investor is to listen to what you shared today. I think you've given back a lot today and just your time and expertise, because often it can seem confusing, right? When operators are talking about the capital stack and investors are trying to figure out where they're at in that capital stack, or what does that mean for them, and this debt, or where does the debt, and where are they at? And unless you're done it a number of times, a little more sophisticated investor, it can be kind of overwhelming to think through. So just grateful for your time today. How can the listeners get in touch with you and learn more about you?
www.colonyhillscapital.com. COLONYHILLSCAPITAL.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.